Welcome to the REI Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the REI Diamond Show with Todd Tresidder on financial freedom. Dan Breslin here, your REI Diamond Show host. Today I am joined by former hedge fund manager Todd Tresidder. Todd has been featured in the Wall Street Journal, Investors Business Daily, Forbes, NPR, and Market Watch, among many other places. Today, Todd brings a unique quantitative viewpoint to real estate investing and shares the reasoning behind his perfectly timed exit from his real estate investments in 2006, 2007, right before the bubble bursts. If you are interested in not getting caught at the top of any market, you'll definitely want to pay close attention. All right, welcome to the show, Todd.
Thanks, Dan. Thanks for having me here.
Absolutely. So you have a pretty interesting backstory as to how you got to, the main business that you are now operating in the real estate space here. So why don't you go ahead, for the listeners that don't know who you are already, just give maybe, the history and how you got to where you're at today and then what the business looks like now.
In terms of my real estate business?
Well, yeah, how did you get there? Where did you come from? And then what are you doing now? What do you got cooking?
Yeah, so my background's hedge fund investing. That's where I built my original wealth, was in the hedge fund business. So I came out of college with this crazy idea that I could make money mathematically. I didn't have to know anything about the stocks or bonds or mutual funds or commodities or any of that stuff, that I could do it all with mathematical algorithms. And my investors professor told me I was nutty, that nobody ever did it. It can't be done. My dad told me I was nutty. Nobody ever did it. It couldn't be done. And so I did it. I was one of the early pioneers of quantitative risk management and investment methodologies. And so that's what we built the hedge fund around. It was immensely successful. We were profitable every single year. The investors had 1 year where we had one little tiny loss to them, even though the fund was profitable, because the fee structure was so lucrative that net, even though the fund made a little bit of money, 1 year the investors lost just a tiny bit. It was a fraction of 1%. And that was a year that I had a whole investment methodology blow up. That's why the fund was only marginally profitable, and I had an entire investment methodology blow up because of a research error. So anyway, that's my background, is quantitative investment methodologies. I'm a bit of a finance geek. I then moved on into the financial education business. I had this crazy idea that financial advice should be separated from investment product sales. Now, again, you have to go back in time. This was in 1998. That it's becoming more of a mainstream thought now. People are recognizing there's tremendous conflict of interest between selling an investment product and advising people on what they should buy or sell. But back when I started the financial coaching business as a education business, that was heresy, right? It was, discount brokers were just starting. People were still doing business with full service brokers and all that. So it was just a very different time. I got into property heavily after about 98. I started getting uncomfortable with the stock market. I was about 2 years too early. Obviously, the final top in the stock market was in 2000. But I started getting uncomfortable with the stock market, and I shifted my assets over to real estate. I started shifting my assets over to real estate in 98, which proved to be good timing, and built a fairly substantial portfolio. I had, at one time, 162 apartment units, and I had a property tax lien business that, I was getting basic, houses and acreage and stuff for pennies on the dollar through the tax lien system. And I sold everything going into the 2006-2007 period. I started getting really uncomfortable about 2005, started trying to figure out how to sell it, but as you know, it takes a while to unwind a portfolio. But I had it completely unwound by the 2007 top. I think it was by the end of 2006, if I can remember. And I haven't reinvested, and we can go into why that is.
Yeah, let's talk about that. I mean, you just mentioned two quite epic, perfect timing examples, Todd, that so many people, I think in their minds, dream that when they're making investments. I know I certainly have ignorantly had that dream, like, oh yeah, I'm just timing the market and it's all perfect. But the reality is, I wasn't in stocks in 98 and I didn't have anywhere near the wealth building experience that you've had in the hedge fund business there with the 98 shift to real estate. And I didn't have as many assets. I just got into business in 2006, but I think I had a delusional mindset that I was like finding, or timing the market, and maybe even still have some of that delusional mindset that I'm like timing the market. But you have two experiences where you did time the market, maybe a year and a half, 2 years ahead of time, which, I mean, in my book, that would go down as like pretty much a perfect experience. So would you mind shedding some light on that as to how intentional that was? And
Sure. Well, let's first of all clarify. Let's clarify. What I did was I managed risk. I didn't time the market. I removed risk from the market, and I reallocated to markets that were less risky, right? Like the way it looks to you is, gee, Todd knew to sell right at the top. No. What was happening was the markets went to absurd valuations in both cases, both the real estate market in 2007 and the stock market from 98 to 2000 top. Both those were absurd valuations to where the risk was not, where the reward was not justified by the risk any longer. So what I did was I reallocated and removed risk. So just to be clear, so that we don't think like, this is anything more than what I claim it is, but it's still interesting, it's still compelling, right? Because you're right, they did result in remarkable timing decisions, but I also want to be totally candid here. You can look, I did not reinvest at the 2009 bottom, okay, which clearly was, in hindsight, a mistake, right? Because the market has, as we record this, it's now August 2017, the market has had one heck of a run back up. So obviously I'm not a perfect market timer, but I am a very good risk manager. See, I was not willing to take on the risk of buying a falling knife, right? That's like grabbing a falling knife buying in 2009. The people that did it, in my opinion, got lucky, right? Because they made a bet that all these government bailouts, the TARP and, all the different things, the government basically violated its own rules in doing what it did, and it was unprecedented what occurred, and anybody that bought that 2009 bottom was making a bet that required those things to happen. I didn't build my wealth by making really crazy bets with really outlier decisions. Your wealth grows according to the mathematical expectancy equation. And the mathematical expectancy equation is probability times payoff. And so the reason I'm so well focused on risk management is I'm managing that payoff equation, which means the key in building wealth is you can't ever have large negative payoffs, right? So the way you grow wealth is you make consistently higher highs and higher lows. And you do that by managing against the large negative payoff, which is what you see me doing in each case, whether I'm selling stocks from 98 to 2000 or whether I'm selling my real estate from 2005 to 2007. What I'm doing is I'm avoiding the large negative payoff. Does that make sense?
It does, and it's a huge philosophical difference to manage the risk as opposed to, like I tried to label what you did market timing, and I appreciate you clearing that up.
Let me give you one more example because it's public and it's in real time right now. So I wrote a post right near the record lows in interest rates called "The Bond Bubble is Here, What to Do Next." And you can find it right on my site. It's clearly on my site, and I've even got a note on it where it dates the post, and it says that it remains unedited since the publication date for posterity reasons. So I basically wrote that post, and I explained the entire philosophy of how you manage risk and how you manage a portfolio with mathematical expectancy in mind. The thing about mathematical expectancy is it's the math that governs the compound return of your wealth, right? All of your wealth is determined by two equations, your mathematical expectancy equation and the future value equation. In the future value equation, the return equation, the investment return equation is governed by the mathematical expectancy equation. So you got to get this stuff down. It's key to growing your wealth consistently. And so I wrote a whole post about the bond bubble, and I basically stated, I have no idea if this is the final top, and it wasn't, right? The bond market has been kind of waffling around with marginal new lows in interest rates, but really going nowhere. But I said, it doesn't matter. I can make a decision right here and now knowing what I know, which is the mathematical expectancy of investing in bonds going forward from the date of publication is less than zero net of inflation. In other words, there's no logical reason to be invested in bonds, to have any allocation to bonds. You can use them as a trading vehicle, but you can't use them as a long-term investment vehicle. And so I allocated entirely out of the bond market, 100% with no regrets. And so I left it there. I've left it there so people can see. That's another example. So that's the third bubble, the bubble du jour, if we will, and it's there in real time. I think it's going to be the next big accident in the markets, is the interest rate market and what it does to bonds. And that's the single biggest market in the world. And so it's going to be absolutely mind-blowingly devastating when it occurs.
Can you talk about why that would be or how that would be devastating, especially for like our audience is primarily real estate investors and mostly single-family real estate investors? What you just talked about, the bond bubble bursting, Todd, can that have impact, and what do you think that could look like if something like that occurs?
Well, of course it has an impact, right? I mean, if you think about the institutional portfolios are laden with bonds, right? If bonds get a negative net real return, what's that going to do to all the institutional portfolios, all the insurance portfolios that are built on actuarial assumptions of a certain minimum return? What about all the pension portfolios that are built around actuarial assumptions of a certain minimum return? What about all the real estate investors where the single biggest cost of owning real estate is your interest cost? And so people are buying real estate at artificially inflated prices because the interest costs are artificially low, right? These aren't sustainable interest rates. They're below any historical norm. They don't make any math sense. There's no business logic to an interest rate this low. It's been manipulated by the government in order to institute government policy, intended government policy. So eventually it has to mean revert. We don't know exactly when, but we know it has to, right? Mathematically, it has to mean revert.
And when you say revert, you mean the interest rates will go up. When you say
interest rates would go up and bonds would decline.
Got it.
We don't know the exact date. We just know that that's the ultimate outcome, right? You're on the tail end of basically, we're pushing almost 40 years of a one-way market in bonds, right? You've had the greatest bull market ever in bonds for 35, 40 years, to where most adults, that's the only reality they know is declining interest rates.
And just for the listeners
you've got to know, there's another concept in investing. It's called the Y-curve effect, which shows that peak valuations are supported by what are low, stable inflation rates, which correspond with low, stable interest rates, which is exactly what we've had for years and years and years now. And that's why you have record valuations across the board, both in bonds and stocks. And it's a well-documented effect. It's called the Y-curve effect. And what happens is any move away from stability causes declines in asset values. It could be a move towards deflation or it could be a move towards inflation. It doesn't matter. Any move away from low stable inflation rates when you're at peak valuations causes a decline in valuations. What you don't have is a perfect timing, right? Nobody knows the future. Nobody knows exactly how it'll occur, but we do know it will occur. We just don't know when, right? But we know mathematically that it will occur. It will mean revert. Valuations will mean revert. Right now, as we record this, the stock market is in the top 3% of historical valuations. You know, the only time period where it's been more favorably or more highly valued is the period leading up to the 2000 top. Other than that, there's no other instances, and we know how that's worked out for investors.
So are these the reasons that you haven't reinvested in real estate and I'm assuming the stock market right now? Are you all in cash, Todd?
No. I have investment methodologies that will cause me to remove risk when the time is right. In the meantime, you know, I can dance while the music plays, but when the music stops, I have investment methodologies for the liquid investment. See, the unique thing about real estate is it's not liquid, and it has a very high transaction cost. And so your holding period, your prescribed holding period, there's a mathematically determined holding period that's a function of market volatility and transaction costs. And so because stocks have very low transaction costs and very high volatility, they don't have a high required holding period in order to be profitable. Whereas real estate, because it's low volatility historically, it's been higher volatility recently because of government policy, but historically it's lower volatility, more stable, and it has extraordinarily high transaction costs, as you well know. And so you really want to have a longer time frame with real estate to optimize your portfolio. And so the reason I haven't gotten back in is more personal than, you know, financial, in that, you know, I'm very careful when I put on financial leverage, which is what real estate involves, right, when you do mortgage financing. And so if I'm going to put on financial leverage with a longer holding period, I have to have confidence. And so I need to see valuations reasonable, and I have to have some reasonable outlook. And with all the leverage in the economy, I just chose other assets. So again, it's that concept of risk removal. I mean, obviously in hindsight, my decision not to buy real estate in 2009, 2010 was a mistake. So I'm trying to be totally candid. I'm not perfect at this, right? But I'm also trying to be really clear that what you're seeing is a consistent focus on risk removal, always managing for that large negative payoff, to avoid that large negative payoff. And so I just chose other assets and other investment strategies as a replacement because they retained liquidity. What I want to be able to do in these extreme market conditions caused by extreme government policy is to remain liquid and to remain mobile. Again, the distinction here is it's defense, right? In other words, I'm always redeploying for offense, but my offense is always in the concept of, can I manage the risk so I don't get a large negative outcome, right? Because so think of it like a sports analogy. What's the team that wins the Super Bowl every year? Is it the team with the absolute greatest offense in the league?
Not necessarily.
Yeah, very seldom. Is it the team with the absolute greatest defense in the league?
Not necessarily.
Very seldom. What it is a team that has in the top 10, 20% in both offense and defense is usually the one that will win the division title every year. In other words, they're balanced. They're a top performer. They're not the best in any one category, but they're a top performer in both categories. And it's logically obvious when you think about it. If you have a great defense, you control the ball, which controls the amount of time your offense can then control the ball, right? Because you're not letting them get many first downs or get many points. And so that means your offense gets more time on the field in order to score more points. So it's this playoff between offense and defense that you have to manage. It's the same thing in investing. So the team that has a great defense, they don't have to have the best offense. They just have to have a good enough offense to put some points on the board. Because as long as they don't lose many points, they don't have to make that many points to win, right?
Managing the risk removal.
Exactly. So it's the same thing in investing. When you become a very good risk manager, risk removal, again, it's the math of compound returns. See, compound returns are asymmetric. This is, again, something a lot of people don't talk about. In other words, if you lose 10%, what percent do you have to make to get back to even on your remaining capital?
You need 10%.
11.1.
Or is it more?
Yeah, slightly more, 11.1. And if you lose 25%, how much do you have to make to get back to even on your remaining capital?
27, 28?
33%.
Oh, nice.
Right? Because, again, just think about it. It's 100 down to 75, so you have to make 25 to get back to even, so 33%. If you lose 50%, what do you have to make to get back to even?
100%?
Exactly. And if you lose 90%, you have to make 900% to get back to even. The point being, the gains and losses are asymmetric, okay? And so it creates an asymptotic curve. The more you lose, the disproportionately larger gain you have to do to get back to even. That's why managing risk is so important. It's baked right into the math of how wealth compounds.
So, Todd, and most of our audience and listeners is probably of a similar mindset. I'm of the mindset of buying property and then getting the rental income and then building a large enough portfolio to achieve financial independence. Would you have a similar or different way of setting up somebody's financial plan? And maybe you'd have some examples with that.
Well, it varies with the individual. Okay, see, you're going to attract to this podcast people who are very interested in real estate. That's why they listen to you, right? Mm-hmm. But the way I teach wealth building, I have a course. It's called the Step 3 course, How to Design Your Life to Result in Wealth. It's how to design your wealth plan that actually work for you. And what I've found out in coaching a lot of people from wide walks of life is there's not one way to skin the cat, okay? So your plan is perfectly acceptable. There's nothing wrong with it if that's what works for you, okay? And that's what works for your followers. But there's also other ways to do it. So let me give you an example. Let me say that let's say I've got a very successful attorney. Okay, he's got a large practice, bunch of sub-attorneys underneath him, paralegals, secretaries, assistants, all that stuff. And this is actually a real client, right? And so he's renting this large office space. And so his wealth plan was very simple. As long as his practice had a time horizon of 15 years or more, it was a no-brainer for him to buy a large office complex personally and have his firm rent it from him. And so that's exactly what he did. He bought for lack of a better term, fourplex of office complex. It's like a large building that had 4 separate offices in it. And then he made the legal firm, his firm, lease the entire space, but then sublease the units that he didn't need until he grew to where he needed all of them, right? But he was safe because now the firm was legally responsible for paying the rent. So as long as his firm stayed in business, which he was committed to, his rent was assured, he was positive cash flow on the property, and that property alone was enough for him to retire on. And then all we did on top of that was have him max out his tax-deferred retirement contributions for him and his wife. And so that was a very simple plan for him, so it involved real estate, but it was unique to his situation. I'll do another one. I had a client his wife was a successful real estate broker, and he was very good, I'm not going to say handyman, but, he was a stay-at-home dad. He was very good with tools. He actually loved working on the stuff. And so his wife, because she had deal flow naturally, she was right in the middle of the deal flow. She was a successful broker in town. They just cherry-picked off properties. And then he would rehab them, fix them up, manage them while taking care of the kids. And that was their wealth plan. It worked great for them because of their life situation. The key is there's 3 asset classes. There's paper assets, which is stocks, bonds, mutual funds, ETFs, that kind of stuff, all the things that a broker, normal financial planner could sell you. And then you've got direct ownership of real estate, which is what you're talking about here. And then you've got business entrepreneurship. And there's no right wrong here. The key is all 3 asset classes have very different characteristics to them. And then what happens is people come to me and they have unique characteristics as well in terms of their life, their skills, their resources, their goals. Each person's unique. And so what you've got to do is take the unique attributes of the individual and then properly match them to the unique attributes of each of the 3 asset classes and then develop their wealth plan that way. And as long as it matches all the math and all that, which we reverse engineer the whole thing, everything, it's all in the course.
Nice. Do you have, or does there exist, maybe like 10 commandments of investment strategy? What would you define maybe as like the 10 basic rules?
You're forcing me to remember it. It's actually on my website. I have 10 commandments of investment strategy. So I don't know if you knew that and you're just pulling it out. Because if you want to prompt me, I can do it, but I can't pull them off the top of my head. Again, I've written so much stuff, I can't just pull it off the top of my head. But yeah, I do have it. It's on my website.
Let's go with the top of head ones, Todd. The ones that actually jump to mind.
Well, I already hit on them.
Commandments. We did touch on a few of them.
The first one is manage risk.
Okay.
Yeah.
Number 1.
I mean, that's why it's been the center point of this conversation is you've got to manage risk. And again, that's baked right into the math of how wealth compounds. It's inviolable mathematics. You either obey it or you get bit in the rear by it.
The other one I had written down was, what was the 7 steps to 7 figures wealth building process, and how does that work?
All right, so 7 steps to 7 figures came out of my 18 years or so of coaching, almost 2 decades of coaching a diverse group of one-on-one coaching clients. I don't accept one-on-one coaching clients anymore because I'm turning all this into a product-based business because I simply couldn't handle the demand for the coaching. I only have so many hours in a day, and there was just too many people wanting the coaching. So I'm putting Todd in a box, and basically my clients taught me how this works. I didn't make up the 7 steps to 7 figures. It got proven out through actually working with real clients and helping them become financially independent. And so each step is a standalone course. Not everybody needs all 7 steps. Like different people come to me at different points in the process. And so the whole idea of creating 7 separate courses is that people can pick and choose the courses that they need at that point in their wealth plan. And then different courses connect to other courses and so on. But, you come to me, you need to start somewhere. And so the only step that's publicly available right now is step 3, which we were talking about, which is how to design your wealth plan properly so it matches your life, so it's personalized to you and will actually work. So that's the step 3 design a wealth plan course. And the reason that's the first one I build, even though it's called step 3, is because it's the starting point where I start with every new client, because you have to have a wealth plan in order to make any of the decisions, because it sets the context for every decision you're going to make, every financial decision you make throughout the day. I mean, you're literally making hundreds of financial decisions every day of your life. You don't know it, but you are. And so the wealth plan sets the context for all those decisions as well as the big ones that you make. So that's step 3. Do you want me to go backwards, Dan, and just kind of give a quick overview of what each of the 7 steps are?
Yeah, that'd be perfect.
Okay, so step 1 is basic financial planning. So it's all the stuff a normal financial planner would do with you. You know, how to get your financial house in order, so to speak, and get all the financial basics. And I'll probably give that course away or make it super cheap just because, it's pretty basic knowledge. It's what normal financial planners do with you. I like to teach the advanced stuff, and that I think is what's worth paying for. Step 2 is the personal side of financial foundation. So if step 1 is the financial side of the financial foundation, step 2 is the habits and attitudes that you operate in your life that ultimately determine your financial outcome. And this was something I had to learn as a coach, was that I had no idea how much of my success was the result of my personal habits and attitudes. And I didn't really fully figure that out until I started coaching clients on how to get out of debt, and I realized that their habits and attitudes were completely opposite habits and attitudes of my wealthy clients. And I started mapping them out and figuring them out, and that's what the Step 2 course is how to create habits, how to build habits and attitudes into your life that automatically pull you towards success. And so that's the personal foundation. So what you're going to see is each of the 2 steps, so step 1 and step 2, and then step 3 and step 4, they're paired off. You've got a financial step and a personal step, and they match up, and you have to get them both right. And so step 3, as I said, is the design your wealth plan, so that's the financial side. And then step 4 is, now that you have your wealth plan, how do you take massive action? How do you take action on that wealth plan and not get in your own way and stop your own success? And so there's 3 different components of that step. And then step 5, which is probably my most in-demand one, is what I call expectancy investing. And that's where I go through a very different approach for how you manage your paper assets and control your risk and increase your expected return and all that stuff. I developed it in my years as a hedge fund manager. It's what I've always used to manage my personal assets. It's what I use to this day. And so I teach that in step 5. Step 6 is going to be less popular. It's for people who are already wealthy. What happens is once you achieve financial independence, and you saw me kind of allude to it in this conversation where I was talking about I don't have to take financial leverage risk. Remember that, Dan? When I was talking about why I didn't invest at the 2009 bottom?
Yeah.
And so what happens is once you achieve financial independence, your investment objectives change. They shift more towards income. They shift more towards risk management. And so step 6 is all about how you manage your portfolio once you achieve financial independence. And then step 7 is kind of brings it full circle. The premise is, so now that you're a millionaire, so what, right? And the whole premise behind that is that nobody achieves wealth because they want more money. They want what they think money will buy. And really, most of us that are pursuing wealth, we have a high value on personal freedom. And so it's about honoring that freedom. And the nice thing is you don't have to be wealthy to do that. And so that's step 7. And so these are logical steps that everybody goes through. You can kind of tell how each one connects. Again, I didn't create them. My clients handed them to me on a silver platter just through direct experience of working with them and seeing how people logically progress through the process.
Yeah, it makes sense. I can relate to having to change some of those things myself. I know my personal attitudes and habits early on were atrocious and were obviously problematic. And I remember having many revelations along the way from wealthy friends, from mentors, from reading books, from conversations with people like you, that really helped to change it. So I imagine there's a ton of value there all around.
Again, I didn't make any of this stuff up. Just as you've been going on the journey and you've been seeing the truth of this stuff, I was on the journey. I saw it in my own life, and then I've been coaching clients through the journey. I've seen it in their lives, and pretty soon what happens is you see the patterns. And that's what the 7 steps to 7 figures is. It's the proven patterns that actually work.
Absolutely. Absolutely. So I'm going to switch gears here a little bit, and I'm going to ask the questions which we ask of every guest that comes on the show here, Todd. For this first one here, I think we're going to go with who is the most successful investor that you would look up to or identify as successful, and why do you think they're successful? Normally we ask that question, Todd, and we're looking for like a real estate-oriented answer, or certainly they do. But I think that you come from a very unique background, so I'm going to broaden that to just any investor that's out there in the market and why you believe they're successful.
Oh, gosh, there's so many. I mean, in the hedge fund space, it's exactly what I was talking about. They understand mathematical expectancy. They understand risk management. They understand a quantitative discipline to the investment process. So there's many, many names in the investment space, but you'd be looking to the hedge fund world and the elite hedge funds that have been closed for new investments long ago. So that would be on the paper asset side. In terms of real estate investment, I've actually got a good friend. He's got a successful chain of hostels in the United States that he developed because he went over to Europe, stayed in the hospitals on a European tour after college, and came back to the U.S. and said, why don't we have these in the U.S.? And so he created them. It's extraordinarily successful now. So the chain is USA Hospitals. He's a good friend of mine. So that would be on the real estate side.
Nice. And do you have 2 or 3 book recommendations that you've made most often, Todd?
Yeah, I think there's a couple. First of all, you give me a layup, I'll recommend my own book as one, but I'm actually serious. How Much Money Do I Need to Retire? By Todd Tresidder. You can get on Amazon. I wrote that book because so many clients had misinformation about how funding retirement works and how much you need and different aspects. So I go through 3 different retirement models, only one of which is conventional, and explain how you can twist the numbers so you can retire a lot earlier than old. And again, retirement's really a euphemism for financial independence, right? So anyway, that book. And then also other books I recommend War of Art by Steven Pressfield, often. Are you familiar with that one?
Yep, I did read that myself. It's a good one. I'd recommend that anyone who hasn't checked it out, take a look.
Yeah, where that one really kicks in is anytime you're trying to move your life forward, you're going to run into personal obstacles, and it's called resistance with a capital R because it kind of deifies the issue of resistance. Extraordinarily important principle to understand. Everybody encounters it, you and me included. All my clients go through it. I coach on it, and yet I still deal with it. It's just hardwired into our DNA. Anytime you're moving your life forward, you're going to encounter resistance. You've got to become good at getting through it if you want to move your life forward. And again, everybody deals with it, me included. I'm constantly fighting it. So that's why I'm so intrigued by it. And Steven Pressfield's written more on it than anybody else. He's got several books on it, including Turning Pro, War of Art, etc. The other book I throw out around is McKeown, Essentialism, and I can never pronounce his last name. Are you familiar with that book?
No, I didn't catch that one.
All right, Essentialism by, I think it's Greg McKeown or something. I forget his first name, but his last name's McKeown. That book's really interesting because in our new information age world, we're all overcommitted, overindulged. There's no shortage of opportunity. There's no shortage of information. You have to develop an ability to sort through what's relevant from what isn't. What is the single most important thing that's going to move you forward versus what is just clutter that's chewing up your time? If you want to produce results with your life, the principles in that book are essential. Pun intended, right? Essentialism.
A couple of them. I'm going to order that one myself. So if you could go back and share the crown jewel of wisdom with your 18 or 20-year-old self, much younger self than you are today, what would that be, Todd?
Buy more real estate. And I'm not doing that just because I'm on this show. I've said it on other places where people ask me what's the single biggest mistake I made. I lived in an apartment too long. I should have become an apartment owner much earlier. So rather than rent an apartment when you're in your 20s and you're used to and comfortable living in an apartment lifestyle, figure out how to beg, borrow, and scrape together a down payment and get yourself a fourplex. And learn the landlording business and make your residence as you live in one of the units as the on-site manager tax deductible. And figure out how to run that stuff. Figure out how the numbers work. Learn how the maintenance works and what things cost. Just get to know it inside out by owning one. And then go get another one. The neat thing about fourplexes in the United States is because, as you well know, you can get fully amortizing fixed-rate 30-year financing on them. It's just like a normal single-family home. You can do that up to 4 units. And so I would do another one. And then once you did that, then do one more. And most people, if they can do that in their 20s and 30s, they'll be financially independent by, 50 years old without a lot of brain power.
That's a great example. I mean, someone said that to me early on. I came through the seminar route to the real estate investment industry. These Flip These Houses, Robert Kiyosaki, Trump, all of them along the way that were around 10 years ago. And someone there told me that same thing. They said, what if, and I was there with my dad, and my dad doesn't have rental properties or anything like that. But they said, what if, your mom, your dad, your grandmom, et cetera, what if they just bought one extra house and rented it out, and then it was paid off 20, 25, 30 years later, and now, they have whatever retirement money they were able to set aside, and then they have their Social Security income, and then they have, the rent from that one property. I mean, how much more would that help? I'm sure anyone listening can think of someone and say, man, if they had only done that and had that additional check, it would have helped so much more. And what you just shared too, Todd, it's the same philosophy that your example with the attorney who bought his commercial property office space did. So, you don't have to be the attorney with a large practice in order to put that same principle you just mentioned there into play. You can do that with your own overhead and the own, triplex, quad, small start rental portfolio, because you have that housing expense anyway. And over the course of time, you're going to pay that thing down. So I think that was a great way to wrap up our interview here. So Todd, is there somewhere that listeners can go to get some more information about you? Maybe check out some of those articles like the bond bubble, the bond bubble is here, what to do next article, or some of the other things we mentioned on our call here?
Yeah, so my home is financialmentor.com. So 2 words mashed together, financialmentor.com. And you can go over there. I have some free bonuses for new subscribers to come over and subscribe. I give away some stuff just to build relationship, and you can get to know my message and decide if it resonates with you, which is I give away a free ebook called 18 Essential Lessons of the Self-Made Millionaire. And in there, I go through a lot of the lessons I've learned along the way that are like fundamental principles. People really like the book. And then I give away a free e-course called 52 Weeks to Financial Freedom. And no, you won't get rich in 52 weeks. I don't teach get rich quick anywhere. It's serious education. But what it does is it goes through in a free email autoresponder course, so you'll just get emails trickled to you. It goes through kind of the highlights and overview of the 7 steps to 7 figures. So you get the framework of how the wealth building process works, and you get kind of the framework of how it all fits together. And so that's all for free as well. And then, if people want to take the next step with me, I have the Step 3 course available now. Depending on when they listen to this interview, I may have more courses available in the future, and I've got some books on Amazon. So again, I'm a pure educator. I don't sell investments. I sell education on how people can do better with their financial lives.
Great. I really appreciate that information, everything that you shared with us today. I will also include the financialmentor.com link in the show notes, so you can just go ahead and click and visit Todd's site if you're listening to this. Todd, I appreciate you taking some time out and sharing this wisdom with me. I have myself, several pages of notes here. It's cool. We talked about some things that were like confirmations and that were like reinforcements of lessons that I had learned the hard way along the way. I took that real estate course back in 2006, and although they said the same thing that you said, hey, this is not a get rich quick thing, where I was at and in the desperation that I had come from before in wanting financial independence, I heard, oh, this is a get rich quick thing. And it took about 9-10 years till I finally got to that point and learned a lot of the lessons the hard way. And I'm sure that it wouldn't take necessarily that long with the right kind of guidance there. Anyway, enough of the diversion. I really appreciate you coming on the show and sharing the wisdom, Todd. Thanks for coming in today.
Yeah, thanks, Dan. Playing off of what you just said, that's why I built this. It's the education I wish I had so I wouldn't have had to learn it the hard way. So it's me giving back and creating a good business out of it. So that's why I built it, is so that, I wish I'd known this stuff back then. So thanks for having me on the show, Dan.
Absolutely, Todd. Thank you for listening to this episode of the REI Diamond Show. Are you interested in receiving a notification when I release the next episode? You can either sign up for email at www.reidiamonds.com or subscribe to one of the podcasting apps, including iTunes, Google Play, and Stitcher. We also have a link for expert guests to apply to come on the show at www.reidiamonds.com. And if you are interested in selling a deal to me or buying a deal from me in one of my markets, please go to that page at www.reidiamonds.com and click the link. I am currently looking for deals in the Philadelphia tri-state area, Baltimore, Maryland, D.C. market, the Chicagoland region, the Atlanta region, and the Tampa Bay area in Florida. And last but not least, do you know anybody else who might also enjoy this episode? I appreciate the referrals, and I'm sure that they would too. Last but not least, I appreciate you, my loyal REI Diamond Show listener. Dan Breslin here. I'll catch you later.
Thank you for listening to this episode of the REI Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.